Welcome back, you legends. I'm Dr. Cal, and let's get right into this video. This is the most important video that I've ever made. This has been the most important trading week of the entire year, and I will go into that right away. Please click on your video settings, set the playback speed to 1.25 to get through the video much more quickly, and please do not skip any part. The entirety of this video is going to be critical. I'm going to cut out all of the fluff, and I will keep the good stuff. So let's get right into it. The stock market closed on Friday up 1.7% on the S&P, up 2.09% on the NASDAQ, and up 1.27% on the Dow. The NASDAQ was leading the rally, which is what we would like to see in a risk-on move. Taking a look at the different sectors, real estate was leading, surprisingly, followed by technology, cyclicals, and communication services. Remember guys, tech, cyclicals, and communication are the more risk-on parts of the market. In the middle, we have basic materials, industrials, and utilities, and then we have financials, healthcare, and consumer defensives and energy was actually more flattish on energy, and consumer defensive closed 1% up in the green. Again, guys, this is what we would like to see. We would like to see rotation out of defensives, out of healthcare, out of utilities. These are all defensive sectors, and we'd like to see more money poured into technology, cyclicals, and communication services. Let's take a look at the stock market map. Clearly green all over the place. The leading sectors again were tech, services, communication services, and cyclicals, and we have some healthcare leading, which is nice to see. We had J&J actually down slightly on some bad news, and then we had energy flat, right? ExxonMobil up nearly 1%, but Chevron was flat on the day. But interestingly, guys, if you look at the weekly performance, the leading sectors were energy, basic materials, and real estate. That's actually somewhat of a tricky thing to see, because if you notice, energy, materials, and real estate, these are the sectors that you want to be in if you want to bet on inflation rising, which is really surprising because last week we had the producer price index and the consumer price index coming in below expectations. So this rally in energy, materials, and real estate is a hint that the market is actually betting that inflation will start to move up again, which is really worrying. You don't want to see inflation move back up, because this entire rally in the stock market that we've seen so far since June has actually been driven by optimism that inflation has peaked. There's no evidence that it has peaked. The market seems to think so far, but we're now seeing a bit of a switch towards last week, where energy is now recovering and inflation plays are back in the game. This is the daily chart of the S&P 500. This is the supply zone that I've drawn up about a couple of weeks back. And look at that, guys. We close right at the top of the supply zone. And this makes a lot of sense, because if we go into the hourly chart, look at that, guys. We had this beautiful gap here, and we completely filled this gap. We closed at the upper edge of this supply zone. So this is very bullish. More importantly, guys, the most important technical development occurred last week, and that is we closed above the 50% retracement level, and here it is on the SPX, the S&P 500 index. This is the 50% retracement level on a closing basis, right, with the closing high back in January and then the closing low that we had in June, and the 50% retracement level was sitting at 42.31, 42.32 just about, and we clearly closed above that. So this is a massive win for the bulls. In fact, going back to 1950, guys, going back 70 years in the past, every time we had a 20% decline from the top to the bottom, 20% or more on a closing basis, followed by a 50% recovery on a closing basis, that signaled that the bear market is officially over, and these lows will in fact hold. This does not mean, guys, that we cannot see a retest of the lows, or see a close retest of the lows, where we fill this gap right here at 3,800. Those things are still possible. In fact, there's still a 3% chance that the stock market will make a lower low, based on statistics of different about 61 different studies, I believe, looking back to all the way back to 19 90, there's still a 3% chance that we will make a lower low. But from a risk reward point of view, guys, we did get a massive check mark today, Friday. This is very good news for the bulls. Even if we get a retest of the lows, there's again only a 3% chance that we will undercut those lows. So this signals the end of the bear market on a technical basis from a statistical point of view. And I did back test this statistic, and it did in fact confirm that we have never seen a 20% plus decline on a closing basis followed by a 50% recovery again on a closing basis without the bear market ending. So this is probably the end of the bear market. This does not mean that we will go straight away to all-time highs and volatility is over. It does not mean that. We could still see declines. We could still see choppiness. That is all possible. It just speaks to the odds that this is the low in June. Now let's take a look at the triple Qs. The triple Qs again made a significant development back here on the 29th of July. That was the first time ever that we broke out of this descending channel. We have now closed above the May highs. On the S&P 500, we got really close to taking out the May highs. We might stall around these levels. We do have some resistance levels coming up here, guys. If we take a look at the daily chart, we have the 200 daily moving average that will likely work as very strong resistance at these levels. Even if the bear market is over, right? Even if we don't see any significant declines, we could still see choppiness and sideways movement well into late August. And in fact, guys, on the 27th of August, we will have the Jackson Hole meeting, the yearly Fed meeting. So we will hear a lot of Fed speakers talk late August. Again, guys, according to seasonality as well, August tends to see a jump in volatility, and in September we tend to see an even higher jump in volatility, and that indicates even wilder price swings. And more often than not, when volatility comes, prices decline, they don't move up. Let's take a look at the VIX. The VIX has actually been declining for several weeks now. Let's take a look at the declining streak. 1, 2, 3, 4, 5, 6, 7, 8 straight weeks of declines. This is extremely rare. Statistically speaking, guys, this week will likely see a green candle in volatility. So we will see a spike in volatility. Likely, it's not a guarantee, but it's very likely that we will see volatility start to pick up. It does not necessarily mean that the market will sell off. That is possible, but we could still just see some choppiness. We do have a number of different gaps that I'm looking at. We have this gap right here at $411 on the SPY. We have another gap right here at 378. The main zones that I'm looking at, guys, for a medium-term pullback is around 390 and again 380. And finally, if we get a really strong pullback, we can expect to see a fill of this gap right around here at $365 on the S&P 500. So again, the immediate zones right here, this is an important zone, guys, because it acted as support, then resistance, and then we broke through it. So this will be a new demand zone right here at $390. This is an important technical zone right here at 380 just because of this gap, but this is a more critical zone in my opinion. So if we do pull back here, we will see a lot of buy demand. We might see a brief break through, a false break, and then a move back to the upside. I'm still looking at September, October in terms of a time frame for the pullback. Again, guys, September tends to be the worst month of the year and is particularly bad in midterm years. In fact, let's take a look at the seasonality chart right here, guys. We bottomed in June, about mid-June. So we did follow this seasonality. We had a July rally. We did not have much of a pullback in July. We had a really tiny pullback right here in late July, another smaller one in mid-July, but no big pullbacks really. We had this massive August rally. We'll probably now move sideways. We've seen this consistently in midterm years. Taking a look at all the different midterm years, guys, we do not tend to take out the May highs. And on the S&P 500, we have not yet taken out the May highs. So I am still looking at some consolidation here, some choppiness, some pullbacks to at least $410 on the S&P 500. So even though I'm turning more bullish, guys, because I'm following the statistics, it's really important to have a disciplined strategy. And based on the data, again, guys, there's a 97% chance that this is the bottom. So I'm definitely definitely turning more bullish as we get more technical indicators turning bullish, but that does not mean that I will just go all in and FOMO into the market. No, I will be looking for pullbacks to strategically build on some positions that I have and open new positions. Again, this is a key support line that we have, and this line does support a possible pullback to $400 and $390 towards the end of August, early September. We can see a break through and a breakdown of this support line in September. That is possible. We could see some false break, in which case we will have another resistance line turn support that I'll be looking at, right? This acted as resistance consistently, and once we broke through that, we had this massive rally. So this is a critical resistance line that has now probably turned support as we turn bullish. So again, we might see something like this, guys, towards the beginning of September, a push back up. We get a rejection right around here at the upper border of the descending channel, and one final plunge in September, right, to go back to these levels right here. That will undertake the lows of June, and there's a 3% chance of that happening. More likely, we will see shallower pullbacks than that. Let's go back to seasonality. We do tend to get a sell-off towards the end of August, and again in September, and again after the first half of October. So these will all be amazing opportunities to accumulate shares, open new positions, bullish positions, etc. At the end of the video, I will show you exactly how I am positioned right now in my longer term investment account, and I do have a lot of cash that I intend to deploy throughout the next let's call it 2 months to build more bullish positions. Now let's take a look at the IWM. The IWM has been on an absolute tear from the bottom. We have rallied 22% so far, and this rally has been led a lot of by short covering and a lot by FOMO and meme stocks. FOMO, fear of missing out, and meme stocks. So it makes sense that we've seen this massive rally in the IWM. We have now slammed into the 200 daily moving average. This will no doubtedly act as a strong resistance level. I will now be looking at the IWM to go back down and perhaps test the 100 daily moving average, this light blue line, and that again will probably be a nice place to accumulate some more small cap shares. I do want to show you this ratio chart, guys. This is the small caps divided by the S&P 500, and again during periods of weakness in the market, we do tend to see a flat lining of this ratio, right, just like we're seeing now. And as soon as we see a break of that, look at that, we tend to see a massive rally in small caps. We are now sitting at a critical level right here. I do expect some choppiness here and possibly a break in October or later in November, and a massive rally in small cap stocks, in which case, guys, I will be talking more about different small caps that I like. I do like to invest in individual names rather than the IWM, the Russell 2000 index. I do not like the whole index. The index is filled with a lot of zombie companies, a lot of garbage companies, so I will be picking stocks rather than buying the entire index. Let's take a look at Apple. Apple has been on an absolutely insane rally. We have moved up 33% so far. In fact, year to date, guys, we are barely down. Look at that. Look at how strong Apple has been. I did not expect that Apple will break out of this channel, but it did. And not only it did that, it went absolutely nuts. Look at these massive gaps that we've left right here. We had a massive gap, another gap right here, and this one last gap. So where does Apple go from here? Apple's been on an absolutely insane tear. This will come to an end, no doubt. We do have this very strong resistance line coming in where we saw significant selling in the past. I do expect to see Apple bounce off this resistance line and start to sell off. Where we go from there is going to be really interesting. I do have this critical support level. It was a pivot level, right? We had support, right over here. We broke through, we went back up, broke through, went back up, broke through, went back up, and then we broke through that one last time. It acted as strong resistance until we broke through it again. So between $155 to $150, that's the likely pullback scenario for Apple going into September and into October, in my opinion. Let's take a look at Microsoft. Again, Microsoft has been consolidating for ages now. It put on that low in June. We've been moving sideways for a long time. We have finally broken through this descending channel, and I do suspect that a lot of buying will come into Microsoft. I do not like the valuation on Microsoft or Apple. It's approaching 30 times forward earnings, and that's a lot. That's way too much in my opinion, especially if we see a jump back in inflation. That will put a lot of pressure on valuations and will push all of these mega cap tech stocks back down. Let's take a look at Google. Again, we've been moving sideways for months and months and months. We formed a bottom in Google right here in late May, so we bottomed earlier than the rest of the market. Chart, we do have this consolidation, very significant consolidation. This did look like a bear flag, but this breakout above the resistance zone right here invalidates this bear flag, so this looks more like an accumulation bottom. Where do we go from here? The 100 weekly moving average is a clear level to look at $130 just about. We do have some resistance right here and a declining 50 period weekly moving average, so this does make a lot of sense to me. And Google has not run as fast as Apple, so there's still some opportunity here. In my opinion, the valuation is also more reasonable. Let's take a look at the daily chart for XLE, the energy ETF. We did talk a lot about this triple negative divergence. Right here, we had this triple negative divergence on the 2-hour chart. We talked a lot about it. It did mark the bottom. This was the perfect place to get back into energy, and it did rally. This was a fairly easy divergence and a fairly easy level to catch for many reasons. One, we had this beautiful ascending channel, and then we went to the bottom of the channel. We had that triple negative divergence. We made that final bottom, and then look at that, guys. We had this beautiful bullish crossover on the daily MACD, and that did signal the bottom, and a rally was in. I am bullish on energy. I do not think that energy prices will ease as much as people think. I do not think oil will crash or anything like that. I did suspect for a long time that oil will hold around $100. This has proven to be true. Now, if we do see a break above $100 and a test of 105 to 110, this, guys, will signal a false break, and this will be a false break bottom. A lot of people are calling for $85. Some are even calling for $60 on oil. I'm very suspect of $60. $85 is possible. It depends a lot on what happens with the upcoming inflation reports next month and what happens in terms of geopolitics. So again, if this proves to be a false break bottom, expect oil to go all the way to test the highs of $125 at least, and possibly go back to $130. That's my opinion. We do have this beautiful double bottom formation on the PPO with a positive divergence, a negative divergence, where a lower low on the price action has actually made a higher low on the MACD. This is a very strong bottoming signal. Again, I am still looking at a bullish crossover and a break through $100. If we hold there for a while, guys, let's say a week or two, that will be a great signal to go back long on oil. Let's take a look at the 10-year yield. The 10-year yield, guys, is a proxy for inflation. When inflation fears soar, the 10-year yield moves up. When inflation fears abate, the 10-year yield declines. I am now looking for a head and shoulders formation to form on the 10-year yield. I do expect the 10-year yield to possibly make one last attempt at a rally. We do have this bullish crossover on the PPO, and it makes sense to me. We've seen commodities recovering, we've seen oil recovering, we've seen basic materials and the energy sector recovering. So there's been a ghost shift. There's been a ghost pattern, a underlying shift in the market that is suggesting that the market is actually turning more bullish on inflation. Okay, so maybe the rally in tech stocks starts to cool down and it moves towards inflation, the inflation trade that includes basic materials and energy. Let's take a look at the 2-year yield. This is the 2-year yield on a weekly time frame, guys. We did have this bearish crossover here. We are now declining, so we do have wind at our faces. This is a headwind, but usually, guys, for the 2-year yield to actually form a final or a last top, we do tend to see a final touch of the faster moving average on the MACD touching the slower moving average, so the blue line touching the orange line, and that will form one last major divergence, and that will probably mark the top in yields. I do suspect that the 2-year yield will possibly run to anywhere from 3.5% all the way to 4%, depending on where the Fed moves interest rates towards the end of the year. Consensus seems to be around 3.5 to 3.8%, and I think that's probably about right. Okay, that is probably about right. And we do have this bullish crossover right here at the 0% line. So this is a bullish development, guys, right? So there's still a possibility that the 2-year yield will rally. And this is important, guys, because the 2-year yield is negatively correlated with the NASDAQ and tech stocks. So when the 2-year yield rallies, the tech sector will sell off. That's why I follow it. That's why it's important. Let's take a look at the semiconductor index. Again, semiconductors, chip companies have been the best performing sector in the entire market since 2016. So for the past 6 years, they've been the best performing sector, and for very good reason. And in my opinion, a lot of them are undervalued. They have a lot of growth potential, and everything in the world requires chips. Okay, importantly, what do we have here? We had a double rejection out of this resistance line back here in December, one rejection line right here in the March rally, and we had this one rejection in August, early August, and now we're seeing a breakthrough. So this is very important. This is subtle, okay, but oftentimes technical analysis is about subtle changes, and this is a subtle change. One other subtle change, guys, look at this. This is the PPO. Take a look at this. We topped, we went back down, we did not manage to cross over. We topped, we crossed over right here. We topped, we crossed over right here. And here at the bottom, not only did we top and cross over, but we had this massive negative divergence signaling a final top in the semiconductors. This is the opposite, guys. We're now seeing a bullish development. We're not seeing a crossover. We're seeing a shallow pullback, right, to the 20-period daily moving average, and now we've broken through this resistance line. So my suspicion is that AMD and Nvidia will start ripping to the upside significantly. I was in fact waiting for AMD to make a retest of this ascending channel, this border of this ascending channel. We could still see that, right? We could still see something like that into September and into October. But now I'm leaning even more bullish. We have this significant breakout above the descending channel on AMD, and we are holding. Right, we had this pullback and we're now holding. I will still wait for a pullback on AMD. I do not want to rush into this. I did in fact load up right here, so I did catch the bottom almost perfectly. I did buy at $77, and I did buy options exactly at the bottom. I did buy options, but I sold those options right here. I did not get back into the options, because I do suspect that we will move probably more sideways. We might see a retest in the next couple of months. And as we move sideways, or as we start to see some dissipation of this rally, this will crunch option prices to the downside, and I was looking to load up on options on a long-term options position, a leap option going into 2024. So as I'm not looking to buy a lot more shares, I'm looking to buy a lot more options. I am looking for a better entry for my options, and I suspect that we might get a better entry in the next couple of months. Same thing on Nvidia here, guys. We had this beautiful rally. Not only did we fill this gap, we went all the way up. We did not manage to take out the June highs, but Nvidia does have earnings coming in a not next week, but the week after, right? I think on the 22nd of August, if I'm not mistaken, and I will be watching for a break out of this descending channel. And again, I'm still hoping for a pullback in September, in October, that takes us down. I do suspect that we will get that pullback, but my hope is that the pullback is deep enough to touch this border of this ascending, long-term ascending channel, because that will be the perfect entry to get into Nvidia Leap options. Let's take a look at GameStop, meme stocks. GameStop has been moving sideways for a long time. If you've been buying options on GameStop, you've been losing money. Option sellers have been making money hand over fist on GameStop because the options are so expensive, and it hasn't really made that big of a move, right? Since this low right here in May, we haven't seen that much big of a rally, right? We did not manage to take this high right here. I do not like the option chain on GameStop. It's way too expensive, and I do not think there's too much upside. There's upside, but I think there are better opportunities out there in GameStop. We might still see a crunch to the upside, a slow grind to the upside. That is still possible. But remember, guys, a slow grind to the upside will still lead to massive losses on your option position. Let's take a look at AMC. AMC has been stronger than GameStop. We've still not managed to take this high, though. We did watch this descending 200 daily moving average for a long time. I did talk about how important this close above the 200 daily moving average. This was different. This looked different than this, right? We spiked and rejected. This time we moved up and we closed above the 200 daily moving average. So this was a significant development for AMC. We do have some dilution coming for AMC, which is really bad news for AMC investors, unfortunately. So still not my favorite meme stock. My favorite meme stock is Bed Bath & Beyond. I absolutely love this stock. I love this double bottom formation. I love this triple negative divergence. This marked the bottom beautifully, absolutely beautifully. This was a beautiful buy at the bottom. I did get into it a little bit late. I started looking at it right here. I did not manage to open any positions near the $8 level, unfortunately, because we gapped up massively. But I did buy on this pullback. So I do suspect that we will see, in fact, another gap to the upside. Because this looks super frothy. Look at how wide the distance is between the fast moving average and the slow moving average on the MACD. This is extremely bullish. I did in fact say when we were at $8 that my initial target was for us to hit $12.50, right? Because we had this very clear resistance zone. We tagged that zone at 13 bucks exactly. So we hit that right on the nose. My target was 12.5 because I like to take profits before we hit the resistance level, right? To be a safer trader, to take on less risk, to take profits before other people, right? To avoid getting trapped in the trade. The next obvious level, the next obvious supply level is right here, guys, at $20 all the way to $25 and $30. So that's my next target. I'm looking at least 20 bucks all the way to $25. Longer term, this could go absolutely parabolic. Look at these Fibonacci levels. $200 is absolutely in play, not only because of the Fibonacci lines, but most importantly, look at this, guys. Look at this absolutely humongous double bottom formation with a positive divergence. The resistance at this double bottom formation is sitting at $35. But more importantly, guys, Bed Bath & Beyond is sitting at about a $1 billion valuation. This valuation could easily jump 10x, no problem, easily could go all the way to $10 billion. This company is in fact valued like it is going bankrupt tomorrow, but as more and more people pile into the stock, this will in fact end up saving the company. It has a little bit of debt on its balance sheet. Well, it's not a little bit of debt, it's somewhat of a substantial level of debt, but the stronger the price moves to the upside, the easier it is for Bed Bath & Beyond to issue warrants, to issue shares, and completely pay off that debt, and that will absolutely save the company. Okay, so I'm absolutely not bearish on Bed Bath & Beyond. I think it's bullish from a fundamental point of view, from a technical point of view, and from an insane momentum meme point of view as well. So in terms of valuations, I think this could easily 10x from here. Even more than that, I think this at the very top could at least go to $400, maybe even $1,000 on the condition that the meme stock euphoria continues. If we end up stalling at the $35 to $40 level, that will be a warning sign. But if we see the euphoria continue even through the weakness of September and October, we could see a massive comeback in November, December, and January. And we do have Steve Cohen, in fact, holding the $80 strike on the call options expiring in January. These are the furthest out of the money options, and he bought so many options. So all of these things are still very, very bullish. I think, honestly, if we see a similar move to GameStop, I think we go to all-time highs easily. $200 is within play for sure. At $200, Bed Bath & Beyond would be valued around $15 billion, a $15 billion market cap, and the company generates $7 billion in revenues. So that is still not like insane meme stock valuation levels. Insane meme stock valuation levels similar to what we've seen on GameStop would put this stock at anywhere between $400 and $1,000. Again, guys, this is not investment advice. I do not, in fact, recommend that you get into this name as an investment. Do not put more than you are willing to lose on something like this. In fact, I will be taking profits probably at $25, and I will completely exit my position, take all of those profits and put them into options, taking my risk to zero basically on this entire trade. So I will try to manage risk as much as I can. Finally, guys, next week, what do we have in terms of economic drops? We have the Home Builders Index on Monday. We also have some housing data, housing starts on Tuesday. On Wednesday, we have retail sales, right? We have business inventory levels. We also have Fed Governor Michelle Bowman speaking. And on Thursday, we have the jobless claims, the job numbers, more Fed speak, and then Friday we have more Fed speak and the advanced report and selected services. So not a lot of data coming out next week, just jobs and some Fed speak. Hey you legends, this is Dr. Cal in the editing room. I just found out as I was editing this video that it was going to be significantly longer than an hour. So I'm going to be cutting off right here and publishing this time sensitive info. The second part of the video talks about all of the bottoming indicators and answers the critical question: is this the market bottom? Did we bottom? Is this a new bull market? Are we going to see pullbacks? How significant are those pullbacks going to be? When are we going to see those declines? When should you buy stock? When you should go fully long? All of those questions will be answered in full. It's going to be the most significant video that you will see this year from me. This is when millionaires are made. So thank you so much for watching, guys, and stick around. That second part will be uploaded soon. Stick around for that. You will not want to miss that. Bye-bye.
Oh, wow.